So a year ago, I made this video where I showed you what I thought was the best portfolio that you could make using Vanguard funds in the UK. So I thought it would be a good time now to revisit the subject and give everything a second look and a quick refresh just to make sure that with everything going on in the world, the portfolio is still something that works and can get us through what might be a pretty difficult few years. So here's the plan. Just using funds from Vanguard, can we put together a simple portfolio that you could set and forget for the rest of your life and just invest as much as you can, as often as you can, and then let the rest just take care of itself. The last time I made this video, there were 76 different options on Vanguard's website, and now there's 81. Great, so even more confusion. But don't despair just yet. I'm going to break things down really simply and get rid of a lot of these options which I really don't think matter to the vast majority of investors who just want to keep things really, really simple. So with your tea or coffee at the ready, let's run through our options and I'll share with you several different options which I think could be the only portfolio that you need for life. After all, the less time you spend worrying about your investments, the more time that you can actually spend actually living. So let's get started. First things first, let me help you whittle down some of these options from Vanguard to make things a little easier. As we just said, there's 81 different options on Vanguard's website here in the UK, which is a load more than you'll ever need. As an investor, if you're anything like me, you want to grow your money. Firstly, to beat your arch nemesis inflation, but then also to give you some kind of freedom to be able to buy or do whatever you want sometime in the future. So in order to do that, we need to invest in assets that will grow in value. So in theory, that sounds really simple and obvious, but in practice, it's a reminder that not everything we invest in will go up in value over time, even if we're onto a sure thing. Just to let you know, we won't be using any of Vanguard's target retirement or life strategy ranges here or anything to do with bonds. If you are interested in those, I do have other videos on my channel, so feel free to go check them out afterwards. First up, we've got to remind ourselves that firstly, we've got no idea what the future will hold and where the growth will come from. So to get around this, we need to focus on owning as much of the world as possible. And I know that sounds like something a supervillain would say, but it's just as true in the world of investing. You see, we don't want to own shares of companies here in the UK or in the rest of Europe or even places like China or Japan or even in the US only. The reason we want to make sure we spread our investments out all comes down to good diversification, and it's the same reasoning why you'd never want to have all of your investments in just one single company. It's extremely risky, and no matter how confident you are that this company might change the world, there are so many risks out of your control and many things you can never foresee. So let's reduce our risk and keep things well diversified. Okay, so now that we've agreed that we want to keep our investments nicely diversified, how do we actually decide where to invest? Do we put more money into Japan, the UK, the US, big companies or small companies? Well, to keep things really simple, one of the simplest and easiest ways to do this is by looking at the market cap or market weight of the different stock markets in the world. Really simply, we'll allocate our money depending on the total value of the market. It's the most popular way that passive investing funds are allocated, and when we do things this way, we don't have to stress or worry about how much of our cash we need to invest and where. So, for example, if we have £100 to invest and the US is 60% of the global stock market value, then we put £60 to work in the US. Nice and simple, right? So going back to working out what the best portfolio is for life, we've decided we want to invest in the whole world and stay diversified. There's actually two ways we can do this. We can actually just invest in one single fund that will allow us to own the whole world, but more on that topic later. Or we can be a little bit more creative and actually save ourselves a small amount of ongoing fees and tailor the portfolio however we like. If we break down the world from an investing perspective, there are two major parts. You've got the developed world and then you've got the emerging markets. There are some differences in the way that some indexing companies split up the two, but we won't get into that in this video. To keep things simple, we need to find out how much weight is in the developing world and how much weight is in the emerging markets. Remember how we spoke about that part earlier? Well, thankfully, this is really easy to find out. With a bit of digging on the internet, you can work this out. I've pulled the latest data from FTSE Russell, who has kindly broken down their entire all-world index that they track. If we scroll through it, we can get to the bit we need pretty quick. As you can see on screen, FTSE Russell are saying that the total market cap of their global index is just over $60 trillion. And when broken down into developed market and emerging markets, the split looks like this. Just under 54 trillion in the developed market and just over 6 trillion in the emerging market. So in percentage terms, you're looking at a split that's nice and easy to work out, 90% in the developed world and 10% in the emerging markets, which funny enough is very close to what I came up to in my last video last year, which was 88% and 12% respectively. Right, so now we've got our two parts that we need and the weight. So the next step is finding out which Vanguard funds would let us make this portfolio, and this part again is really simple. There are two funds here that will do the trick nicely. Firstly, we can use the FTSE Developed World ETF, which has a ticker symbol of VEVE. By the way, I'm letting you know that because as a little side note, you can buy Vanguard funds on pretty much any investing app or platform that you like. So feel free to go ahead and use whatever you already have or prefer, whether that's Trading 212, Free Trade, InvestEngine, Vanguard directly, or even brokers like Hargreaves Lansdowne and many others. Also, see my links in the description below for all the latest offers on those platforms. Then as our second fund, to cover off the emerging markets, we can use the FTSE Emerging Markets ETF, which has a ticker symbol of VFEM. So going back to our percentages, a portfolio for life might be 90% in the developed markets and 10% in the emerging markets. That's just 2 funds that you need to invest in, and you'll never have to look at a company balance sheet or listen to a quarterly report ever in your life. Just to show you some more details of how this breaks down, let me show you what this portfolio looks like in some more detail, and let's talk about costs and holdings. On screen now, if you hold these 2 funds, here's what you actually get according to the latest information on Vanguard's website. You can see that between the 2 funds, you'll have a total of 4,134 companies. You'll hold stocks in virtually every country in the world, including the US, the UK, Japan, China, Canada, Brazil, you name it. And also, let's not forget about low ongoing fees too. The developed fund has ongoing costs of 0.12%, and the emerging markets fund has a slightly higher cost of 0.22%. So if we have to weight those costs to get our average based on a 90-10 split, your total average cost you end up with is 0.13%, which based on my own research, I think is pretty much the cheapest global fund you can make yourself, at least when compared against other global ETFs that you can find out from the likes of Vanguard themselves or players like iShares from BlackRock. You can definitely find some mutual funds that look cheaper on the surface, but bear in mind that mutual funds will have some further hidden costs to add in, and they are often on platforms with higher fees, so just bear that in mind. Now, just a couple of details worth mentioning here, because these funds are both ETFs, you will need to buy a full share of each one in order to build your portfolio. And there are minimum order sizes, at least on Vanguard's own platform, that they say you'll need to meet in order to invest monthly or as a one-off cost. So with ETFs, you need to buy them like shares. So for example, if you want to invest £100 each month, you'd actually need to be able to buy whole shares of these funds. And at the time of making this video, the developed market fund costs £65 a share and the emerging market fund costs £47 a share. So that's £112 in total if you wanted to start off with one of each. Although then that would technically mean that we have a 50-50 split rather than a 90-10 split. However, you could always gradually move it more toward the developed fund as you added more shares. Anyway, just something to be aware of. Okay, so that's our ultimate Vanguard portfolio if you're happy to use a couple of funds. But like I said earlier, you can also just buy a single fund and own the entire world according to market weights in just a single ETF or mutual fund. This option might be better for someone who almost wants nothing to do with their investments and doesn't even want to worry about rebalancing or getting things in order. As per the video I made last year, this part has stayed the same. If you want one single ETF to invest in that covers most of the world, then this might be the option for you. Enter Vanguard's FTSE All World ETF with a ticker symbol now burned into my head of VWRL. This fund has got 3,782 companies inside of it, and it's pretty much a combination of what we've just made, but all in a single place. You've got stocks from all over the world, organised according to their market weight, and you won't have to spend a single second trying to rebalance anything. You could very easily set up a direct debit to invest in this fund each month and get a couple of shares. Do that for many decades and you should be in a pretty good place. The only real thing pointing out here is that the costs are slightly higher for this convenience. So if you see here, the ongoing cost of VWRL is 0.22%, which is 50% higher than what we've just made ourselves, but I'd be lying if I thought that was expensive compared to any other mutual funds in the past. Just for fun, let me compare what the fee difference would be over 20 years so you can see the difference that a small fee could make. Let's assume £200 a month over that time period with an average rate of return of 8% per year, which is pretty fair. With that, we end up with £117,804. Now, if we run the same numbers and reduce the amount of return by the difference between 0.22% and 0.13%, which is 0.09%, we'll then be doing the exact same thing, but now rather than 8%, we'll get 7.91%. Hopefully you're still with me. So again, let's run those numbers, but now at 7.91% over 20 years, and we end up with £116,495. So call it £1,000 difference over 20 years, £50 a year, or about £4 a month. It's probably not going to break the bank, and it will scale the more money you invest each month and the longer you do it for, but personally, I'd not stress about it too much and really find a portfolio that suits your style of investing and one that just works for you. Remember, this is just my opinion and thoughts, and I'm not a qualified financial advisor. It really is up to you to do your own research and work out your own path. Now, one important point worth considering that I did touch on last year is also important to consider and be aware of, even though really there's not a huge amount that you can actually do about it, and that's the exchange rate. As you might know, as much as you love your pounds in your pocket, it's a big world out there, and in the business world, everything is ruled by the US dollar, and it's the global reserve currency, and it's how major commodities like oil are traded. Even the big companies here in the UK earn most of their income outside of the UK, so every time you invest with your pounds, sometimes you get a good exchange rate and sometimes you're going to get a bad one. Now, over a long period of time, you'll hope that you'll get somewhere in the middle and a fair price. The only issues you might have is that when it comes to selling your investments, you might want to be strategic about doing it, especially if you needed to sell them all at once, as then you'll technically be locking in whatever the exchange rate was at the time. All of this can get really complicated, and there are many people out there who can go into the nitty-gritty details, but for me personally, it's not something I really worry about, but just be aware about it. Now, it's worth saying that on a video like this, where I'm claiming to make the ultimate and best Vanguard portfolio, the single most important thing is really your ability to be able to invest consistently with as much money as possible over that long term. Whether you choose to have a global fund or make your own one like we've just done, we won't actually know which route performs better until the future's already happened. So unless you can time travel for me and find out, we won't know if a single fund ends up performing better than some 10 fund portfolio made up from a whole load of different kinds of stocks. Because we can't control that part, there's no point worrying about it. And so instead, focus on what you can control, and that's your own behavior and investing habits. The key word there being habits. If you can make your own investing as easy as simple as paying your mobile phone bill each month, then you'll probably end up a lot better off than 90% of people around you. There's no magic amount of money or magic formula to any of this, you just have to be very consistent and very boring over a long period of time. If you're still confused after all of this, don't forget that I have entire playlists for investing for beginners on my channel, link in the description for all of those and on screen now. Feel free to take your time and watch those before trying to build anything yourself, and check out my description for links of all of my brokers that I use to get yourself some free shares. Anyway, thanks again so much for watching. I'll see you in the next video, and as always, happy investing.